From the morning reading, stocks float on a sea of red as volume falls. 2015 final day of trading on Thursday. Happy New Year. All 9 sectors moved lower on Wednesday. XLU, XLP, and XLV were the strongest sectors, while XLE was the weakest sector. All 9 sector ETFs recorded volume drops of 12 to 60% below average. Breadth weakened as decliners led advances, 2.45 to 1 on the New York Stock Exchange and 2.36 to 1 on the Nasdaq. Small and mid-cap stocks continue to lag behind the S&P 500 index. Consumer staples and utilities are December leaders, while cyclicals and industrials lag behind. Rotation from cyclicals to staples is a sign of caution. Energy Spider continues to test support. Year-end rally kicks in. That's reason enough to wish everyone a Happy New Year. Defensive stocks lead the December rally. A year-end stock rebound has boosted major stock indexes, the S&P 500 touching a 3-week high yesterday. It still, however, remains below a falling resistance line drawn over its November-December highs and is trying to stay above its 2 moving average lines. So far, however, this remains only a large cap rally. The S&P 400 mid-cap index trading below both moving average lines and well below its November high. The Russell 2000 small cap index in a similar weak condition. Since mid-year, the SPX large cap index is basically unchanged. At the same time, the mid caps are down -5% and the small caps an even larger -7%. That's not the sign of a strong market. And that situation is unlikely to improve until smaller stocks start to act better. Defensive leadership. Sector leadership during December also reveals a more defensive market mood. The 3 top sectors during December are consumer staples, utilities, and healthcare. All 3 are defensive in nature. Consumer staples, XLP, hitting a new high. Its relative strength ratio has risen all month. The utility spider, XLU, also having a strong month. Its relative strength ratio has risen as well. Investors usually rotate into those sectors when they're more cautious on the direction of the market. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:55 a.m. Central Time, and I'm recording this in preparation for the market day of December the 31st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And action was decidedly flat overnight, and still is so. At the time of this cut, the S&P futures were down only about 1.5 points, essentially scratch. The Russell was dead on scratch. Nasdaq was just below scratch, as was the Dow. Crude oil was down about 2/3%. Euro down about 1/3%. Bonds up about 0.2%, and gold is essentially scratch. In terms of overseas action, remember this is New Year's Eve, and some of these markets are nearly closed or already closed. Indeed, China is down about 1%. Hong Kong is up about 0.15%. Japan is up about 0.25% at the time of the close. This shows 12/30 as the date, so there may not have actually been any action last night in Japan at all. Same may be true with Germany. Also notice it has a 12/30 date on that. United Kingdom down 0.5%. In terms of macroeconomic reports for today in the U.S., there are some reports. We have the weekly unemployment claims, we have Chicago PMI and nat gas storage, all kind of on their normal schedules. But then, of course, the markets will not have a normal schedule today. They'll close midday and then be closed outright tomorrow. Also, you probably have The European markets, if they haven't already closed, they're probably nearly closed. So a lot of volume is going to dry up, and it'll really only be U.S. traders trading with themselves here in pretty short order. And then that will even dry up, as many of the head traders, they're already gone and away from the desk and leaving it with juniors who are basically told to not mess anything up. So bottom line, don't expect there to be much in the way of fireworks today. Probably very, very light volume, directionless, very poor intraday trading, and very poor follow-ups. So always could change, always could be something that you don't expect, but the probabilities are that today will be a very, very mild day. Perhaps a slightly bullish tendency, as there are forces out there that are likely to want to make sure that the Dow closes on a positive for the year, not drip into the negative. But anyhow, bottom line is that we're not likely to have much trading action today. In terms of current market conditions, short-term VIX you see is at a 15.96, so that did tick up a little bit yesterday with a bit of down action. Skew remains quite elevated at a 143. IV percentiles, though, continue to be very low. 23 on the S&P, 19 on the Russell, 20 on the NASDAQ, and 20 on the Dow. We did have standard deviation moves put in on 3 of the 4 indices. The S&P was the one that did not have at least one standard deviation move, and it was pretty close. If you'd done some rounding, you probably could even have called that a 1. Certainly, its move was not as pronounced as the other markets, who were clearly over a 1 standard deviation move. So we continue to see significant price action, even if there's no fear premium. There's no, in quotes, volatility, as people typically refer to volatility, but there's plenty of volatility in terms of price action, as we have chattered back and forth. And you look at the Russell here, virtually every single day during full trading sessions in the last 2 weeks have seen more than 1 standard deviation move. So this is certainly, in quotes, volatile, though it hasn't actually accomplished much. And indeed, we can go ahead and go to the charts. On the SPX, you notice we have something of a bearish Harami pattern here. So the day before, and you recall, I mentioned I was going to be surprised if we get through this action. Well, indeed, we did close through that action, but then it didn't hold, and we just promptly nullified that. So this just becomes a similar high and not a breakout, did not mean anything. And part of all that also is the fact that this was done on very low volume. You'll recall that this was something like 60-something million shares on a daily average of about 118 million. And this was also on very low volume. So I basically would put the combined action of all this in the last 2 days to essentially we're right back where we began, and this was not a breakout, and this isn't particularly bearish either at this point, because none of it really was with full participation, and none of it really went anywhere. So we're just still range bound, and range bound until proven otherwise. We're sitting right at the top of the cloud, big fat flat cloud. Again, an indication of range-bound activity. And until we truly break out of these tops up here, and really the all-time top high around the 2120 or the 2130 area on the SPX, or we break below 2000, it really doesn't mean much of anything. It's just noise, though something of a wide avenue of noise. In terms of the Dow, it is very similar action. Also a bearish Harami, but again on very low volume, preceding or following another day with very low volume. NASDAQ, same kind of action. Very, very noisy action here. Let's see if the Russell gives us anything else to be noticing. Really nothing other than it's flat in the middle of the cloud, in the middle of the definition of chop. In terms of volatility, as in the VIX futures. It's just in the middle of chop here. It's been playing right around this 18 area, above and below, just around the 18 mark. And currently with the intraday futures, it is above, but just marginally so. And then bonds. Bonds have been weak of late, showing a little bit of a rebound so far today, but again, nothing of particular note. So probably going to be more of the same today, nothing of particular note. In terms of the daily guide, daily report I should say, still looking at this as phase 2 trend reversal, but really nothing in terms of bull flag patterns or anything like that yet. We do have very mixed and kind of transition market with the IBD status now back for the 12th time into the confirmed uptrend. Question, of course, remains, will it accomplish anything this time that has not happened in the prior 11 in 2015? Hopefully in 2016 we'll see some sort of trend move, and frankly, while we all hope for a bull move that serves our portfolios better, if we simply get a trend move either direction, at least we know how to act on that. While we can certainly act on range-bound markets, it's not as fulfilling as it is when we actually have a real trend move and we can take swing trades and other directional trades to be able to take advantage of follow through on those moves. So hopefully we get some resolution. This has been some 13 months in the making now of this range bound action. Accumulation distribution score in the S&P remains very poor at a D-, NASDAQ a D. GMI index also remains a 3 out of a 6 with a sell signal since 12/10. Author remains in cash. And the decision point scoreboard, we did have some changes here on the 29th, and you notice here a positive arrow, positive arrow, positive arrow, positive arrow. Those were basically upgrades, as I recall, from neutral. But again, very mixed total signals in the short term, very mixed long term, very poor stack in terms of these time frames across the different indices with these signals. And indeed, the consensus on all this is that we are a market in transition, and really not much to be able to point to in terms of a bias to the bull side or the bear side at this time. It could go, it would seem, almost either direction. Intermediate term market posture is bullish. In fact, I would make that very bullish with a very slightly bearish sentiment line. So in essence, this is essentially neutral. Position sizing opinions on these mechanical signals are both at 100%, though I would still caution a good bit of defensiveness because these signals have been flip-flopping back and forth. Market posture is indeed mechanically very bullish, and you see the S&P has jumped all the way up to 64.4, Dow also above a 50, NASDAQ above a 50, all three of these in the very bullish area. But again, this has all been done on very, very low volume. And I made reference yesterday to the pre-Memorial Day week in which we set a 52-week high on very poor volume, only to come back and have all the market participants come back on the following Tuesday after Memorial Day and take it down hard. So I really am very, very skeptical at this point until we see a clean breakout with real volume that the bulls have much going on here right now. And that's part of the reason that while there's very little actually mechanical signals that are giving us negatives, I'm still at a threshold level 1. In terms of the lower signals, you see we continue to be pretty clean. The skew remains quite elevated at about a 7-fold probability of normal for a 2 standard deviation move in the next 30 days. We continue to have the week out expected move in the SPX a bit elevated at a 41. And we also continue to see a little bit of warning from the intermarket risk aversion indicators. There's just one that is risk off, but this is really all in all pretty benign, and normally we could even be a 0 plus on the hedge warning status, but I'm concerned about this poor GMI index and the poor decision points scoreboard with all this poorly stacked time frames and the like, and we just seem to kind of chatter back and forth without actually accomplishing anything. So we're going to continue to leave this at a hedge warning status of a 1. That's not to say that we think the market's going to go down or a prediction of how far it's going to go down. It is a prediction that or opinion I should say, that the hedge risk level in the current market is elevated, and that there's very much conditions present that could lead to a significant fall off in the market. Now, it's a level 1. It's not a 2. It's not a 3. It is just level 1, yellow light, caution. So take that for what it is. In terms of sentiment indicators, we do have on the fear and greed of 47, so pretty neutral. In terms of our special opinions, no change from yesterday. I won't go into great detail on this other than to say that while conditions are acceptable to initiate new positions in each of these strategies for novice traders, you'll want to be, I would suggest, very defensive, and I've suggested a number of ways to be defensive here. No changes from yesterday, so I won't go into a lot of detail on this. But bottom line, it's just not a strong bull market, and you've got to behave as such. So in terms of sector specific, energy still quite poor, transportation still quite poor. Most of the others are at least neutral, but remember, many of these lines are quite wrapped around flat averages, and they're flip-flopping green with a little bit of up action and down to red with a little bit of down action. So these are very quick to change their signals in the current market conditions. Percent change yesterday was universally down, though utilities held up pretty well. Again, those defensive areas of the market being the ones that held up well, and the high beta and very aggressive sectors were the ones that lost the most. So these are the places where people are afraid to hold positions other than very short kind of trading environments, whereas it would seem with reference to the early morning reading headlines that I shared at the beginning of the talk, that people were going with more volume, that relative strength was climbing in places like utilities, those defensive sectors. So kind of keep all that in mind, and be also, with your own trading, mirroring that defensiveness. So that should be enough with that today. In terms of special opportunities, will mention some greater details about the covered call class. I did put the hyperlink here, so you might want to take a snapshot of this, and if you pull up that hyperlink, that'll give you the sheet here that I'm going to show you right now, and I'll go into some detail on this today. But we are offering a covered call mastery course, and this course is a very comprehensive introduction to options through the use of the covered call strategy. And attendees will be able to walk away from this course with a complete rules-based covered call strategy trading plan ready to go. So this will be you'll absolutely have mastered this strategy and have a very solid introduction to options. So if you've ever wanted to get an understanding of how to apply options to your stock trading, this would be a great opportunity to jump on it. The course will begin on Saturday, January the 30th, and will take place for 4 hours from 10 to 2, and then we'll have 4 additional Saturdays on the dates that you see here. So there'll be a total of 20 hours of class-based instruction. But in addition to the class-based instruction, we are following up this with significant application time, and course registration will include access to our regular live trading room, where we'll support your education during the length of the course, plus a follow-on of 6 months access to the live trading room to be able to master application of your covered call strategy trading plan. So significant number of hours there that you'll have available to instruction. The location of this course will be in the Chicago western suburbs for those that are live, but it'll also be virtual. So if you are in New York or California or somewhere else, it is no big deal. It will be simulcast. It'll be recorded. If you're not available on Saturdays, it'll be recorded. You'll still be able to get to everything that is happening. Course price is $500 per person, but that includes the textbooks. There'll be 2 textbooks as well as the lab fees. That's the access to the live trading rooms for a number of months. What it also includes is this multi-week comprehensive mastery course. Again, the 2 textbooks, $100 worth of value. There'll be a 3-ring notebook that'll have all the PowerPoint slides, various handouts, and other supplemental materials. And you can see a little bit about the course content, but bottom line, stock screening, fundamental analysis, technical analysis, all the calculations, trade execution, a range of exit strategies that we're going to learn with all the various normal exits for covered calls depending on what might happen. We'll go through all that, and we'll apply all that in a lab setting in the live market through the trading room. So very, very comprehensive. If you believe that this is something that you would like to register for, just send me an email to Stephen@FalconGlobalTraders.com, and then I will send a registration form out to you straight away. So that's the details on this course. Would love to have you there. We think we've put together something really special. And in terms of this morning market preview, if you find that this is helpful to your trading, as always, we greatly appreciate you acknowledging that. Subscribe to the YouTube channel, like us there, retweet us to your Twitter followers, etc. Disclaimers as always, hit the pause button if you need more time to review. You see the full hyperlink to go to the full disclosures if you need to see all the legal stuff. And we will be back on the new year, the first trading session. There'll be no market preview tomorrow, no trading tomorrow. But in the meantime, have a very happy holiday season and good trading to you. And then hopefully we'll put together a fantastic 2016 for all of our trading efforts.